Purchase and sales transactions are recorded by both parties to the transaction. When purchases are made on account, the buyer accounting record for the purchase transaction has a corresponding purchase transaction in the seller's or sales transaction in the seller's record. The buyer's accounts payable account balance with the seller's should agree with the seller's accounts receivable account with the buyer. So when we're buying something, the seller is going to have a sale, we'll have a purchase, and when we owe money, the other side will show that we owe them money, they'll have a receivable. To illustrate, Solar Company sells merchandise to the buyer Inc. on account for $800. The freight terms are FOB shipping point, and the buyer pays $53 in cash to the freight company. Make sure you look up that term, FOB shipping and FOB destination, so you understand that term. The cost of the merchandise is $548. Both companies use the perpetual inventory system, so we're going to fill out the amount. For the seller, we're going to have a sale of $800 and an accounts receivable of $800. So accounts receivable $800, credit sales for $800. We're also going to record the cost of that sale, and that's $548. Next, on the buyer is going to pay for that inventory, and they paid $800, but they also paid for the shipping of that material. So they're going to record the purchase of it of $800 and accounts payable to the seller of $800. And then they're going to record the cost of the shipping, $53, adding that to the cost of the material, and reducing their cash for $53. So the total cost of those that product that the buyer purchased was actually $853, not $800, because they had to pay the shipping. Just like if you buy something over the internet, and let's say it's $20, you buy it on the internet, but then there's a shipping cost and sales tax to it. What's your true cost? Well, it's going to be the $20 plus the shipping plus the sales tax, and so your cost is actually higher than just the $20. Next, it says Reed Corporation is a medium-sized manufacturer of electronic components that supplies Brady Company with many component parts. Brady Company also supplies Reed with some of the finished products it develops. Hence, both companies purchase and sell to each other. Both companies are located in Oregon, which has no sales tax. Both companies use a perpetual inventory system. Therefore, sales tax does not apply to any of these transactions, and you should record the merchandise transactions using the perpetual inventory method. The analysis of each transaction described by rolling over the date from the perspective of each party in the first journal entry space, record each transaction as it affects Reed Company on the appropriate day. The record for the same day transactions in the bottom space affect Brady Company. So we have Reed Company here, and down here we have Brady Company. If no entry is required, select no entry required and leave it blank. So here we're going to start by holding it over the date, and it says Brady Company purchased 1,800 of merchandise on account from Reed Company. The merchandise was sold on credit term of $310 net 30 shipping terms FOB shipping point. The cost of the merchandise to the seller is $1,290. So Brady's purchasing it, we're selling it for $1,830. So we're going to have accounts receivable for $1,830. We'll have sales for $18.30. We'll have our cost of merchandise sold, and that was how much again? That was $12.99. And we will have our merchandise inventory credit for $12.99.